All right, welcome to this explainer. Today we're diving straight into the fascinating and honestly kind of baffling financial metrics of Glaukos Corporation. If you follow the medtech sector, you probably already know that Glaukos, trading under the ticker symbol GKOS, has been making some serious waves. But when you actually pull back the curtain and peek at the raw data, well, a really compelling mystery starts to emerge. We're going to unpack that whole paradox today, leaning heavily into their valuation ratios and historical averages to tell a story that might just catch you off guard. Let's get right into it.
So, to understand why everyone is paying such close attention, we gotta start right here, 203.10%. Over the last 3 years, Glaukos has handed its investors a staggering 203% total return. Just think about that for a second. If you had parked your cash in this stock 36 months ago, you'd be looking at triple your money right now. It is a massive, undeniable win for shareholders, and it really paints this picture of an absolutely unstoppable growth engine.
On the surface, man, it sounds like the flawless growth story, right? But what if I told you this company is actually losing money? Yeah. So the million-dollar question here is figuring out exactly how a stock rallies like this, literally delivering triple-digit returns when the bottom line is just deeply, deeply in the red. How on earth does the market justify rewarding a business that isn't actually turning a profit?
Section 1. 3-year growth engines. Price versus revenue.
Okay, this right here brilliantly illustrates the gap we're dealing with. Over the last 3 years, the stock price has compounded at an explosive 42.08% annually. But get this, the actual revenue growth rate over that exact same period? It's only 21.49%. Now, look, 21% top-line growth is absolutely respectable, for sure. But it tells us that the stock's valuation is expanding almost twice as fast as the actual sales coming in the front door.
Section 2. The profitability, reality, the bottom line.
Looking at the trailing 12 months, the divergence is clear as day. Glaukos brought in over $507 million in revenue, which, implies some really serious market penetration. Yet at the exact same time, they posted a massive net loss of nearly $188 million over that period. Basically, they're spending significantly more to generate that revenue than they actually get to keep.
And it is super important to point out that this isn't just, a one-off bad year because of some sudden macro shift or a weird accounting charge. If we look at their 3-year net income compound annual growth rate, it is completely flat, 0%. On top of that, they're operating with a deeply negative net profit margin of roughly negative 29%. Every single dollar of revenue they bring in is dragging along substantial losses. The top line is growing, sure, but the bottom line, it literally hasn't budged an inch toward profitability.
Section 3. Unpacking valuation ratios. The premium.
So to really wrap our heads around the sheer scale of the premium investors are willing to pay right now, the PEG ratio is absolutely our best lens. See, for a hyper-growth medtech company, a negative PE ratio might actually be forgiven if the growth rate is equally out of this world. The PEG ratio, the price-to-earnings to growth ratio, is what tells us if that growth actually justifies the hefty price tag.
Now, when we compare these current multiples to the company's own historical averages, the bloat becomes undeniable. Just look at this. The current PEG ratio sits at 2.75. That is roughly 85% above its historical 3-year baseline of 1.48. Meanwhile, the price-to-earnings ratio remains deeply, deeply negative at minus 44.07, which is actually slightly worse than its historical average. What we're seeing is the market paying a historically high premium for a company whose earnings profile is still firmly in the red.
And honestly, that wild enthusiasm just bleeds into almost every other metric. Price to sales sits at 1650, enterprise value to sales is over 16, and price to book is nearly 13. All of these are comfortably sitting well above their historical 3-year averages. It's kind of like a valuation balloon. But hey, to give credit where credit is totally due, the underlying foundation does have a safety net. They are operating with an incredibly safe debt-to-equity ratio of just 0.10, so they aren't aggressively leveraging debt just to survive this cash burn, which is a major relief.
Section 4. Making sense of the math. Synthesizing the data.
All right, when we pull all these numbers together, this quote really hits the nail on the head regarding the current reality. The stock price outpaces actual revenue growth, trading at a premium across almost all historical valuation multiples despite negative earnings. The big takeaway from all the data we've just walked through is that investors are happily, almost eagerly, paying a massive premium today. They're looking right past that negative $188 million in net income, and they are betting heavily on future profitability. They're basically assuming that this 21% revenue growth is eventually going to cascade down and fix those negative margins.
So, That leaves us with the ultimate question to ponder as we wrap up this explainer. Does a solid, but let's face it, not astronomical, 3-year revenue growth rate of 21.49% truly justify a historically bloated PEG ratio of 2.75 and a price-to-sales ratio over 16? Is this just a visionary market accurately pricing in a future medtech monopoly? Or is the market simply mispricing the stock's fair value in a huge wave of momentum? I'll leave you to look at your own portfolios and decide for yourselves. Thanks so much for joining me on this explainer.